Hey everyone, and welcome back to the channel. If you're part of Gen Z and thinking about getting your first credit card, this video is for you. This one piece of plastic can either be your secret weapon for building a strong financial future or a one-way ticket to Debt City. Choosing the right card from the start is super important because the wrong one can get you into trouble faster than you think. So, let's break down everything you need to know to make a smart choice. First, why should you even care about credit cards? It might seem like just another way to spend money, but it's so much more than that. Your credit history is basically your financial report card. Landlords look at it before they rent you an apartment. Lenders check it before they approve you for a car loan or a mortgage. Some employers even check it before hiring you. Starting to build a good credit history early, like in your late teens or early 20s, gives you a massive advantage. The main goal here isn't to spend more money, it's to prove that you can handle money responsibly. So, what makes a credit card beginner-friendly? It's not about flashy perks or huge credit limits. First, look for a card with no annual fee, or a very low one. You shouldn't have to pay just to have the card in your wallet, especially when you're just starting out. Next, the reward structure should be simple. Complicated points systems can be confusing. Straightforward cash back on all purchases is usually the best way to go. The card should also be easy to get approved for, even if you have a limited or non-existent credit history. And finally, a good beginner card will have a clean, easy-to-use mobile app. You need to be able to track your spending and pay your bill effortlessly. Now let's talk about the different types of cards available for beginners. The first and most common type is a student credit card. These are specifically designed for college students and often have lower credit limits and are easier to qualify for. They might even offer rewards for good grades. If you're not a student, a secured credit card is an amazing option. With a secured card, you make a small cash deposit, say $200, and that becomes your credit limit. This deposit protects the bank, so they're much more likely to approve you. After you've shown responsible use for about 6 to 12 months, you can often get your deposit back and upgrade to a regular unsecured card. Lastly, there are some entry-level unsecured cards that are designed for people with limited credit history, but these can sometimes be a bit harder to get approved for right away. When you're comparing cards, there are a few key features you absolutely need to look for. The most important is the APR, or annual percentage rate. This is the interest you'll pay if you don't pay your bill in full. As a beginner, you want this to be as low as possible, even though your goal should be to never carry a balance. Also, check for hidden fees. Things like foreign transaction fees or late payment fees can add up. Make sure you read the fine print. Simple rewards, like 1% or 2% cash back on your purchases, are a great bonus. And a really helpful feature that many cards offer now is free credit score tracking. This lets you see your progress and helps you understand what actions affect your score. Just as important is knowing what to avoid. Steer clear of cards with high annual fees. Unless you're getting some incredible value back, which is rare for a beginner, it's not worth it. Also, avoid cards with really complicated reward systems that make you jump through hoops to earn or redeem points. Simplicity is your friend. Be very wary of cards with high penalty fees or a high penalty APR. One late payment shouldn't send your finances into a tailspin. And finally, avoid any card that seems to be encouraging you to spend more than you can afford. The goal is to build credit, not get into debt. Okay, so you've got your first card. How do you use it safely? This is the most critical part. Rule number 1. Use it for small, planned purchases. Think of it as a debit card. Use it for your gas, your groceries, or your monthly subscriptions. Things you were going to buy anyway. Rule number 2, and this is non-negotiable. Pay the entire balance in full every single month. This prevents you from ever paying a single cent in interest. Rule number 3 is to keep your credit utilization low. This means you should try to use less than 30% of your available credit limit. So if your limit is $1,000, try not to have a balance of more than $300 at any given time. And finally, never ever miss a payment. Set up automatic payments or calendar reminders. A single late payment can seriously damage your credit score. Let's talk about some common beginner mistakes so you can avoid them. The biggest mistake is treating credit as free money. It is not. It's a loan that you have to pay back. Another huge error is only paying the minimum amount due. If you only pay the minimum, interest will pile up quickly and you could be in debt for years. Applying for too many cards at once is another red flag. Each application creates a hard inquiry on your credit report, and too many of these can lower your score. Finally, don't max out your credit card. This skyrockets your credit utilization and tells lenders you might be in financial distress. You might be wondering, how fast can I actually build credit? The good news is, you can see improvements pretty quickly. If you make your payments on time and keep your balances low, you could see your credit score start to climb within just a few months. Building a really strong, excellent score takes time and consistent good habits over several years. Remember, your payment history is the single most important factor in your credit score. So consistency is key. A quick word on rewards versus credit building. It's easy to get drawn in by promises of cashback, points, and miles. But as a beginner, rewards should be a nice bonus, not your main goal. Your primary focus is building a positive credit history. The financial discipline you develop by paying your bill on time and in full every month is infinitely more valuable than any cashback you could earn. The interest you'd pay from bad habits will quickly erase any reward benefits, so always prioritize responsible use over chasing rewards. So what's the final takeaway? The best credit card for a beginner is the one you can manage responsibly. Think of a credit card as a tool, not as an extension of your income. It's there to help you build a better financial future, not to buy things you can't afford. Using it smartly today is one of the best things you can do to set yourself up for financial freedom tomorrow. Start small, be disciplined, and you'll be on your way to building an amazing credit history. Let's talk about the different types of credit cards out there, because not all plastic is created equal, especially when you're just starting out. The three main categories you'll encounter are student credit cards, secured credit cards, and entry-level unsecured cards. First up, student credit cards. As the name suggests, these are specifically designed for college students. The banks know you probably don't have a long credit history or a high income, so the approval requirements are generally more lenient. They often come with no annual fee and might even offer some small perks, like cashback on textbooks or at restaurants near campus. A great example is the Discover It Student Cashback Card. It has a rotating 5% cashback category, which can be fun. And Discover matches all the cashback you earn in your first year. It's a fantastic way to learn the ropes of rewards without getting overwhelmed. The key here is that you usually need to be an enrolled student to qualify. Next, we have secured credit cards. Now, don't let the word secured scare you. It's actually one of the safest ways to build or rebuild credit. Here's how it works. You provide a small refundable security deposit to the bank, usually a few $100s. That deposit then becomes your credit limit. So if you deposit $300, you get a credit card with a $300 limit. You use the card just like a regular credit card, making purchases and paying your bill each month. Because the bank is holding your deposit as collateral, they're taking on very little risk. This makes it much easier to get approved, even with zero credit history. After you've shown a pattern of responsible use for about 6 to 12 months, many banks will graduate you to an unsecured card and refund your deposit. The Capital One Quicksilver Secured Rewards Card is a solid choice because it even offers cash back, which is rare for secured cards. Think of it as putting training wheels on your credit journey. Finally, there are entry-level unsecured cards. These are the standard credit cards that don't require a security deposit. Banks are taking a bigger risk on you, so they might be a little harder to get than a student or secured card if you have no history. However, there are some great options for beginners. These cards typically have no annual fee and simple, straightforward rewards. For instance, the Petal 2 Cashback, no fees Visa card is a standout. It's designed for people with thin or no credit files because it can look at your banking history to assess your creditworthiness, not just a credit score. It has no fees of any kind, no annual fee, no late fee, no foreign transaction fee, which is amazing for a beginner. The goal with any of these is to find a card that will approve you and help you start building that positive payment history. So when you're comparing these beginner-friendly cards, what specific features should be on your checklist? Let's break it down. First and foremost, look for a low or ideally zero annual fee. As a beginner, You shouldn't have to pay a yearly fee just for the privilege of holding a card. There are plenty of fantastic, no annual fee cards out there, so don't settle for one that charges you. That money is better off in your savings account. Next, pay close attention to the interest rate, or APR, which stands for annual percentage rate. This is the interest you'll be charged if you carry a balance from one month to the next. As a beginner, your APR will likely be on the higher side, maybe somewhere between 18% and 28%. While the goal is to never carry a balance by paying your bill in full every month, life happens. So, knowing your APR is crucial. A lower APR is always better, but your primary defense against interest is paying off your statement balance every single time. Simple rewards are your friend. A lot of premium cards have these complicated reward systems with points, transfer partners, and travel portals. Forget all that for now. You want something simple, like flat rate cashback. A card that gives you 1% or 1.5% cashback on every single purchase is easy to understand and track. It keeps the focus on your spending habits, not on chasing rewards. Another huge feature is access to credit score tracking. Many major card issuers, like Discover, Capital One, and Chase, offer free credit score monitoring through their apps. This is an invaluable tool. It allows you to see your progress in real time and understand how your actions, like paying your bill on time, are directly impacting your score. It gamifies the process of building good credit and keeps you motivated. Finally, and this is a big one, look for a card with a clean, user-friendly mobile app. You're going to be managing your account on your phone. You need an app that makes it easy to check your balance, see your transactions, and, most importantly, pay your bill. A good app will also let you set up payment reminders and alerts to help you stay on track. Now, just as important as what to look for is what to avoid. Let's cover the red flags. As I mentioned, avoid cards with high annual fees. Unless a card is giving you benefits that far outweigh the fee, which is unlikely for a beginner, just say no. Store credit cards can also be tricky. They might offer you a 10% or 20% discount on your purchase that day, which sounds tempting. But they often come with sky-high interest rates and can only be used at that one store. It's usually better to get a general-purpose card from Visa, MasterCard, or Discover. Also, be wary of cards with overly complicated reward systems. If you need a spreadsheet to figure out if you're getting value, it's not the right card for you. Your focus is building credit, not becoming a travel hacker overnight. That can come later. And watch out for high penalty fees. Read the fine print to see what the late payment fee or returned payment fee is. While you should plan to never incur these, it's good to know what you're dealing with. Most importantly, avoid any card or marketing that encourages you to overspend. Credit is not free money. If a card's whole pitch is about buying things you can't afford, run the other way. The best card is one that acts as a tool for financial responsibility. Okay, so you've picked your card, it's arrived in the mail, you've activated it. Now what? The most critical part is learning how to use it safely and responsibly. This is where the habits you build will set the stage for your entire financial future. First rule: treat your credit card like a debit card. This is the golden rule. Only use it for small planned purchases that you already have the money for in your bank account. Think of it as a payment tool, not a loan. Are you grabbing a coffee? Use the credit card. Paying for your monthly streaming service? Put it on the card. Buying groceries for the week? Perfect. By doing this, you're not spending any extra money. You're just changing the method of payment. Rule number 2 is an extension of the first. Pay your balance in full every single month. I cannot stress this enough. When you get your monthly statement, you'll see a statement balance and a minimum payment. Ignore the minimum payment. Paying only the minimum is a debt trap. It's how credit card companies make most of their money from interest charges. Always, always, always pay the full statement balance by the due date. The best way to do this is to set up auto-pay from your checking account. It's a set-it-and-forget-it strategy that guarantees you'll never miss a payment. Rule number 3 is about your credit utilization ratio. This sounds technical, but it's simple. It's the amount of credit you're using divided by your total credit limit. For example, if you have a $500 credit limit and you have a $50 balance, your utilization is 10%. Lenders like to see a low utilization ratio, generally below 30%. A high ratio can signal to them that you're too reliant on credit. So, on that $500 limit, try to keep your balance below $150 at all times. A good trick is to make a payment before your statement even closes to keep the reported balance low. Let's touch on some common mistakes beginners make because seeing the pitfalls can help you avoid them. The biggest one is treating credit as free money. The moment you buy something on credit that you couldn't afford with cash, you've crossed a dangerous line. Another huge mistake is only paying the minimum. Let's do some quick math. If you have a $1,000 balance on a card with a 21% APR and you only pay the minimum, it could take you over 10 years to pay it off, and you'd pay hundreds, if not thousands, in interest alone. It's a cycle of debt that's hard to break. Applying for too many cards at once is another rookie error. Every time you apply for a credit card, it results in a hard inquiry on your credit report, which can temporarily lower your score by a few points. It also lowers your average age of accounts. So, do your research, pick one good starter card and stick with it for at least a year before considering another. And finally, maxing out your credit card. This is a major red flag on your credit report. It skyrockets your credit utilization to 100% and signals financial distress. It will tank your credit score. Never let your balance get anywhere near your credit limit. So, to wrap it all up, your first credit card is a powerful tool. Choosing the right one, something with no annual fee and simple terms, is the first step. But how you use it is what truly matters. Use it for planned purchases, pay the bill in full every month, and keep your balance low. A credit card is not an extension of your income. It's a way to build a financial reputation. The smart, responsible habits you build today will directly lead to your financial freedom tomorrow. It'll open doors to better loans, lower insurance rates, and more opportunities than you can imagine. Start smart, stay disciplined, and you'll be well on your way. Thanks for watching, and be sure to subscribe for more tips on mastering your money.